What is capital gains tax? Well, capital gains tax is a tax you pay on the gain of capital. Funny how that sounds. So how do you calculate that? You start with what your cost basis is, and then you take all of your improvements that add to your cost basis that you have receipts for, and then you take your selling price minus the cost of selling, and that difference is your capital gain. Now, what the government says to you is they're going to give you a capital gains tax exemption, not deduction, exemption on a primary residence. So what does that look like? What is a primary residence? Interesting is the primary residence is deemed to be something you've lived in 2 out of the last 5 years. It could be any of those 2 years, but it's 2 out of the last 5 years. Now, if it's primary residence, the government's going to give you $250,000 capital gains tax exemption. Free money, $250,000, $250,000. Spouses, married couple living on the property on title, you get $500,000 of capital gains tax exemption. Keep this in mind. Real estate's the only asset you own today that if you sold it with a $500,000 gain, you pay no tax. Every other asset you own, you're going to pay a capital gain tax on that. What does that look like? Well, at the federal level, it's up to 20% of the gain. At the state level, state of Hawaii, it's 7.25%. Now, if your adjusted gross income is greater than $400,000, that tax period, you add another 3.8% on top of that. So what are you looking at? Probably about a 30% rough number. About 30% of all the gain you're going to pay to the state and federal government on capital gains taxes.